righty, folks, we've heard from Goldman Sachs, JP Morgan, and others that the recession odds are collapsing. Firms were calling for recessions at one time, up to 90% chance. Obviously, we've had a lot of news in the media, and I just want to ask one person and one person only, Anna Kelly, is the recession canceled? What do you think?
I highly doubt it. It ain't over till the fat lady sings, right?
Yeah.
No, we still have a lot of recessionary conditions, and those things have not yet fully materialized. With layoffs, we're still seeing extended amounts of layoffs, bankruptcies. The consumer is still stretched. CPI just ticked up a little bit again last month. So we have a stretched consumer at the time when inflation is not yet dead. And those things will continue to put pressure on the economy. I believe we're in a recession that has not yet been declared. I don't know if it will be bad or long. The lower retaliatory tariffs are, the less likely that it will be bad and deep and long. But I would say the recession is absolutely not canceled at this point.
Yeah, for me at this point, I think stagflation is like the base case, right? We even have, Fed presidents, in this case, Kugler, he said this morning, I still expect inflation to rise and the economy to slow.
Absolutely.
A la stagflation, right? So it's pretty interesting to think about. The other thing, again, when I step back and look at the broader picture, looking at the economic data that's coming, right? The next 3 months specifically, I'll talk about in a minute. But I also want to talk about consumer behavior.
Yes.
Let's do consumer and business behavior first. So until last Friday, when tariffs on China were still 145%, and we didn't have any indication of this Geneva event changing that. We did on Friday.
Mm-hmm.
A lot of businesses I was hearing from who relied on China were simply not ordering because it didn't make financial sense, right? This widget used to cost 100, now it costs $250, and we sell it for 180, right? Just didn't make sense to them, so they weren't ordering. Now I'm curious, you've got this little reprieve. It's supposed to be a 90-day window. I think any legitimate business owner realized that 90-day window could be collapsed in a tweet, right? People could change their mind in a minute. Let's not get it twisted. So what I think might happen, and it's going to distort the recession call, is we might actually have businesses like right now double and triple ordering.
Well, they've already done that. They did that in the early part of this year.
Yeah,
and
they did
so
in Q1,
that is part, it makes the data very difficult to interpret whether this is a trend or whether this is just a one-time thing. So we saw companies actually saying, and manufacturing new orders actually went up just in certain sectors, especially where there were steel tariffs, and people went out, companies went out, and they bought stuff that they needed to stock up before they thought the depths of, this lock-in, this freeze that Scott Bessent said could take a year or two to negotiate out of. They went and pre-ordered. People went and bought a whole bunch of cars. But this month, those things are softening. So the question is, yes, during this gap, are they going to do it again? And is that going to make it look like you've got, positive GDP all of a sudden because there was all this this anticipatory spending, not because it's something that they can really afford to do and pass the costs on to the consumer.
No, that's why I think it's going to be just, I'll call it a dirty number. It's going to be business and consumer behavior that has no certainty about the future. So again, to your point, this is not a trend. This is like survival, right?
Yes.
Companies doing double and triple ordering, because again, they don't want to do that. That really hits their cash flow. They're holding more inventory than they want. And oh, by the way, to your point, we have a stretched consumer. Who knows if these people are going to show up and they're going to have to put these on sale to move inventory. I mean, it could be wild, but I fully expect if you're a small business relying on stuff coming from China, you've got to be double ordering right now, if not triple. And that's going to distort the May numbers, I think.
Absolutely. And everything comes down to the consumer. And this is why I say the recession isn't canceled. The numbers vary depending on how much government spending versus, the consumer or corporations, but it's over 60% of consumption is consumer spending. And
For
so
sure.
we already know, we've known that 70% of the population's living check to check and that they're stretched. We see credit card defaults rising. We're actually seeing some bankruptcies rising. People searching for bankruptcies, the search requests are rising. And so the consumer is stretched. And those that were keeping the economy afloat were those in the higher income ranges. And now we're seeing a lot of white collar and mid-management job layoffs. And so you saw the stock market, falling. I mean, it's rebounded, gotten back all of its losses. But when people are worried about their portfolio, they're in that upper income level and they're worried about potential job loss, they start pulling back. And we've seen that. We've actually seen a big pullback in things that kept it going, services like travel and airfares. People are starting that have money to say, hey, there's too much uncertainty. We need to be careful here. And uncertainty is what spooks the consumer. It's what spooks the stock market. And the stock market is mostly the higher end consumer. And so until you have clarity and certainty of where are the policies of this administration going to take us in the next year or so, people are on edge. And I kind of said this was like uncertainty on top of uncertainty on top of uncertainty on top of uncertainty, from everything that we've experienced post-COVID, like high inflation, change in administration, tariffs. It's all going, whoa, I thought we were getting close to this soft landing. And now it's like, what's the next pin to pop the bubble? And people are afraid and companies are afraid. And so, where you've got the consumer that is pulling back, they're nervous, they're worried now as they're seeing announcement after announcement. We had more bankruptcies in the first week of May than we've had the rest of the year. UPS, Michael, for example, that relies on shipping and people ordering stuff. We just had 3 big UPS facilities shut down in Pennsylvania. Warn notices. We're laying off people. They're automating and people are buying less. And so when you see these companies like a UPS say, hey, people are pulling back and they don't need as many distribution centers and they lay off thousands of employees, it starts to hit other businesses' psyche as well as the consumer to say, wait a second, all these companies are having earnings misses. People aren't buying and shipping as much stuff. The discretionary buyer is pulling back. And what they're doing, Michael, is other than those that are really threatened by tariffs, they're pulling back on their R&D. They're pulling back on their hiring. As someone who has a son that just graduated college that's looking for jobs, I've been tracking kind of job openings, and the job openings have just plummeted in the last several months. So you've got more people going after the same jobs, even internships, companies that were, having hundreds of applicants and offering about half of them an internship. Now they're like, you got hundreds of applicants and you give 2 internships and, one job has 100+ applicants in 2 days. And they never hear anything. So companies are pulling back hiring. They're pulling back spending. They're cutting their earnings outlooks. And that starts to manifest in CEOs going, there's too much uncertainty. So we're going to stop, pumping the system with money and investing in the future as well until things shake out.
Well, I don't know if you saw it. It just came out. I saw it at 7:00. Microsoft has announced a 3% layoff across the company. And again, that's one of the Mag 7, right? One of the folks that are investing in AI, and they too now are laying off, looking for efficiency. So again, we are in this thing. I think there's plenty of pain coming. The other thing that's interesting is, let's talk about inflation. I just want people to realize I've been talking about the next 3 months all year because it's just how inflation is calculated. It's called the base effect. So inflation came out this morning. Headline came in at 2.3. Last month was 2.4. 2.3 is a 4-year low, right? People are going to be, yay, right, declaring victory. Unfortunately, the next 3 months, the base effect is not helpful. The previous 3 months, it was very helpful. It made the number look worse. So there is a very good chance that come the August report, the headline inflation is not 2.3, it's like 2.7 or 2.8. And that's going to look like inflation is coming roaring back. So again, the chances of rate cuts this year, I think, are not very good. In fact, Goldman Sachs and JP Morgan both said first rate cut December. So it's getting interesting out there. And let's be clear, the last thing I'll say about rate cuts, if we get rate cuts before December, it's because unemployment broke.
Yes.
That's why.
Absolutely. And again, both sides have risks, right? I think the worst risk is unemployment, because even if inflation starts to go up and starts to tick up, that's just going to make employers even more nervous, because if they know the consumer is stretched, they're not spending, they can't pass their price increases, their cost increases of the tariff onto the consumer. And so until they prove out that they can, it's actually generally initially inflationary, but then it becomes deflationary. And when you have a consumer that's already stressed and they say, we're not paying your price increase, you have to take a profit hit. Companies can only take profit hits so far. And this isn't to say that some haven't taken advantage, right? They have. Companies are in the business to make a profit. They're going to try to make as much as they can for as long as they can. But when the consumer says, I'm not going out and buying that car, I'm not building the new house, which they're already, stopping doing by and large, tons of new home construction cancellations, for example. When they say, we're done, we're done. What that does is it makes companies have no choice but to cut prices, take the profit hit. And as they cut prices, their gross income is hit first, their stock value starts to go down. They start to then look where else can they cut costs, and that's layoffs. And so inflation is the initial sting of tariffs, but it generally, especially if it's preceded by a time of an unhealthy consumer, becomes very deflationary and actually a drag on the economy. So it makes the recession and growth piece worse until that inflation part comes down. So I think that we are going to have a painful year. Kind of going back to what you just said. I mean, I've been saying for a couple of years now, I think this looks more like a stagflation-like environment, where the real risk is you have both low growth and inflation at the same time, at least for a period of time. And it's very, very, very difficult for the Fed or even fiscal policy on the government side, giving us money or pulling back spending. It's very difficult to get out of. So I think this is going to be a slow trudge until the recession becomes evident. The best thing during stagflation is truly for the recession to just come and be dealt with, let you have the wipeout, and then the economy will have to, have something that sparks stimulation and a new growth cycle. And so that's the thing that kind of, if there's anything I worry about, it's just that this is going to take a lot longer. We're already tired. We've got inflation and recession fatigue, but this is going to take longer to maybe longer than what people think. And unfortunately, to your point, it means that rates aren't easily going to come down. But when the recession call happens and this stuff continues to play out, because here's the thing people don't realize, it's very rare to have a soft landing, to have no recession. Once that train has left the station and you're pretty far down into the low growth, there's a pattern. It keeps coming unless there's something miraculous, this productivity miracle to get you out of it before it starts. And there's really nothing there that's that productivity miracle that's going to happen on the horizon in the next 6 months to a year. It's going to take time for those things to come. So we just need to be patient, and we need to be able to be positioned, like the Fed, to say, if there's more inflation, we've hedged ourselves a bit. If there's less growth, we've hedged ourselves a bit. And so I think this is the time to be in a defensive mode. As much as we always want to grow, we want to look for deals, we want to find income, we want to find appreciation. This is more of a time when everybody should be in a little bit of a defensive preservation mode, saying, I don't know where things are going. The experts don't know where things are going. The policymakers don't know where things are going. And when they all say we don't know, believe them. They don't know. And so the chance of a policy error that makes it worse goes up when people don't know. And so, be hopeful, but be guarded. And this is a time to say, I'm smart enough to know that I'm not smart enough to know what's next or how long it's going to take, because anything could happen, and we need to be positioned for either or. But my bet, if I had to put money on it, is recession eventually gets us out of stagflation. And then we have a couple years of slow growth and recovery before things really pick up steam, hopefully again.
Yeah, the last thing I wanted to talk to you about is one of the proposals in the new budget being put forward by the administration. I don't know if you saw it, but it looks like bonus depreciation will 100% bonus depreciation will be coming back, at least in the proposal. It starts January 20th, 2025, goes to December 31st, 2029. I'm curious if that comes to be and it makes it in the final, whatever it's called, bill or whatever. Do you think that's going to be one of the things that reignites multifamily?
It very well could be. I tell you this, if you don't get it, the pain in multifamily will get even worse because so much of the purchasing and the transactions were really driven. The reason cap rates kept going down and people were paying higher prices is because of the tax benefits and being able to capitalize on selling a property and then rolling into another property. But if you couldn't do it quickly enough to get a 1031, you could take the capital gain hit on the sale, and then you could just use bonus depreciation on what you bought later in the year. And so the tax incentive has a huge impact on the price that people pay for assets. And so I've looked at this historically, and in times when tax benefits were taken away from any kind of business or any kind of investment, investment class like multifamily, values absolutely went down because it just disincentivizes from people having another reason to go do it when there's uncertainty. So I'm actually hoping, I mean, there's some purchases, Michael, this year that I'm delaying until I see whether we're going to get 100% bonus depreciation and whether it's going to be this tax year. I've got some properties I may still want to sell, especially when my mortgage payment doubles if the Fed doesn't cut rates, that I'd love to sell, but I don't have anything to buy. And so if I can't 1031, I need a bonus depreciation. So I have a little more time to find something. And a vehicle. I want to buy another vehicle for my company. If I can buy it and write off 100% of it in the first year, absolutely. You'll see vehicle sales going up as well. And people paying higher price for cars because of the tax incentives. So it's absolutely a stimulatory thing to have 100% bonus depreciation. And Trump is primarily trying to do that to get people to come invest in manufacturing, bring back manufacturing of drugs, of cars, of semiconductors, all of those kind of things. So I would be shocked if they don't put that through. I think he's going to balance it with an increase in the tax rate on the wealthy, which most Republicans don't do. But I think in order to pay for it and to pay for some of this no tax on tips and Social Security and overtime, I think that they'll just raise that upper tax rate on the wealthiest and then give us in tax incentives for them to kind of come offset some of that by investing in the growth of America on the other side of this recession.
Love it. Anna, where can people find you?
You can find me on your show on social media at Anna Kelly, REI Mom. And for real estate and wealth coaching and consulting, you can find me on my website and schedule a time with me at AnnaKellyInvesting.com.
Thank you so much.
Thank you.